Now we'll solve one P&L problem. So December 2014 exam they had asked a P&L, OCI as well as statement of changes in equity. So we'll start reading the problem and then let's solve it together. So December 14 problem. Alpha holds investments in two other entities, beta and gamma. The statements of profit or loss and other comprehensive income and summarized statement of changes in equity of three entities for the year ended 30th September 14 were as follows. So we have revenue, cost of sales, gross profit, distribution costs, admin expenses, redundancy and reorganization costs, investment income, finance cost, profit before tax, income tax expense, profit for the year. Then in other comprehensive income, items that will not be classified to profit or loss, gains on financial assets designated at fair value through other comprehensive income. So it is nothing but FET OCI investment. Then you have total comprehensive income, and then there is a summarized statement of changes in equity, opening balance on 1st October 2013, comprehensive income for the year, and dividends are paid on 31st December 2013, balance at 30th September 2014. So generally the statement of changes in equity doesn't look like this, it is a summarized version. Generally you have share capital, then securities premium, retained earnings, then total equity, and then non-controlling interest. So this is a very summarized version of statement of changes in equity. Note 1. Alpha's investment in beta. On 1st October 2001, Alpha acquired 75% of the equity shares in beta. So underline 1st October 2001. So it is way back, right? Currently we are doing balance sheet as on 30th September 14. At that time they had acquired 75% of the equity. This gave Alpha control over beta. So beta is a subsidiary company. On 1st October 2001, the net assets of beta had a fair value of 80 million. So underline fair value of 80 million. None of the assets and liabilities of beta which existed on 1st October 2001 were still assets or liabilities of beta on 30th September 2013. What does that mean? Either those assets are fully depreciated or they are disposed of. That means in the current year we don't have to take any disposal or depreciation impact. Okay. On 1st October 2001, Alpha measured non-controlling interest in beta at its fair value of 22 million. Underline fair value of 22 million, non-controlling interest. Goodwill on consolidation of 18 million arose on acquisition of beta. No impairment of goodwill on the acquisition of beta has been necessary up to and including 30th September. So what amounts they have given is, first of all there is 75% stake. Then when they acquired beta, at that point of time the fair value was 80 million and the fair value of non-controlling interest was 22 million. Now this information is not relevant for P&L purpose because you don't have during the year impact, but this information will be required for preparing the statement of changes in equity, where you have to compute the opening balance for the year impact and closing balance, right? So after first para you write to be considered for preparing statement of changes in equity, right? And there was also a goodwill amount of 18 million, but till 1st October, the opening date, that is 1st October 2013, it was not impaired. Now let us look at whether impairment is required in current year. Beta has 4 operating segments which are also cash generating units for the purpose of impairment reviews. On 1st October 2001, the goodwill on acquisition of beta was allocated between these units on the following basis. So that 18 million which is calculated is divided in units 1, 2, 3, 4 as 8, 4, 3 and 3, right? So this is 18 million. Now, on 30th September 2014, the carrying amounts of the net assets excluding goodwill and recoverable amounts for 4 CGUs of beta were as follows. So they have given carrying amounts and recoverable value for all the 4 units, and they have said any impairment of goodwill should be charged to cost of sales. So how do you calculate the impairment amount? First you take carrying amount of the respective units, then you allocate the goodwill to the respective amounts, and then compare with the recoverable value. If recoverable value is less than the total carrying amount after allocation of goodwill, then there is an impairment and that amount will be charged to cost of sales. So we have to plot all the numbers in the respective units and check in which unit there is a impairment required, right? So it is a very simple adjustment. So we will do it later on only. Note 2, Alpha's investment in Gamma. On 1st February 2014, Alpha acquired 80% of the equity shares in Gamma and gained control over Gamma. Important date 1st February 2014 and 80%. Now this is an acquisition during the year. Okay. So whatever addition you do, that will be always on a pro rata basis. Because if you compute from 1st February 2014 to 30th September 2014, it is 8 months. So right here 8 months. So you would require to do consolidation in P&L only for 8 months period from the date of acquisition. Next, on 1st February 2014, the fair value of Gamma's property, plant and equipment exceeded the carrying amounts in the individual financial statements of Gamma as follows. Property excess 20 million, land element of excess 11 million. The estimated remaining useful life of the buildings element of the property at 1st February 2014 was 25 years. So property was in excess of 20 million, but out of that property land was 11 million. So the depreciable component is only 9 million. So we are now preparing only P&L. So I have to calculate only depreciation on 9 million for 8 months for 25 years. Are you getting me? So total is 25, out of which land is 11, remaining useful life is 25 years. So 9 million is depreciable component, right, whose useful life is 25 years. But how many months have elapsed? Only 8 months have elapsed from the date of acquisition till the date of reporting. So you write all the relevant facts, then we can compute later on. Right, so 9 million is depreciable, the total useful life is 25 years, but we have to compute the depreciation currently only for 8 months. Plant and equipment excess is 7.2 million. The estimated remaining useful life of plant and equipment at 1st February was 3 years. So 7.2, 3 years, but you only have to calculate for 8 months. Whenever there is an acquisition in the middle of the year, the calculations increases unnecessarily. Otherwise, generally if it is on the first day, then it is very easy. Right? All depreciation of property, plant and equipment is charged to cost of sales. So underline cost of sales. Alpha measured non-controlling interest in Gamma on 1st February 2014 at its fair value of 28 million. So this was the fair value as on the date of acquisition. Again, not required for P&L purpose, but it will be required for statement of changes in equity purpose. So right here to be considered in SOCI. There was no impairment of goodwill arising on the acquisition of Gamma in the year ended 30th September 14. The profit of Gamma for the year ended 30th September 14 accrued evenly over the year, but see note 8 regarding the other comprehensive income. Now what they are saying is, this acquisition was done in the middle of the year and 8 months are remaining. In practice, the profit cannot accrue evenly throughout the year, but for computation purposes in the exam, they have clearly given that you can do it on a pro rata basis. So all these numbers in the P&L are on a 12 months basis. So pro rata 8 months you can consider in the calculation of line by line consolidation. Okay. However, there is an exception for other comprehensive income. P&L items are accrued evenly, but OC items are not accrued evenly. That we will see note later on, right? So just underline accrued evenly here, but see note 8 regarding OCI. So for OCI we will not do a pro rata. For P&L items we will do pro rata, right? Now generally in a P&L problem, if the goodwill impairment is not required, then computation of goodwill is also not required, because goodwill is a balance sheet number. Unless it is impaired, P&L does not require a goodwill computation. So if they have clearly said that impairment of goodwill is required, then only you compute goodwill in a P&L problem. Note 3. Alpha supplies a component used by both beta and gamma. Alpha applies a markup of 25% to cost when computing intragroup selling price. All of the sales of this component by alpha to gamma occurred after the acquisition of gamma on 1st February 2014. Details of the sales components and the holdings of the inventory of the component by group entity are as follows. Now again, alpha is supplying to beta and gamma, so there is a downstream transaction. So alpha supplying it to beta gamma, they apply a markup of 25% to cost. That means 1/5 of selling price. 25%, that means 20% of selling price. That is 1/5. Right? Also, one of the important things to notice, all of the sales of this component by alpha to gamma occurred after the acquisition of gamma. That means everything is post acquisition. Whenever it is post acquisition, you have to eliminate in full, because it is during it was subsidiary, right? Now they have given total sales, which is 12,000 and 5,000. So everything is post acquisition. So entire 17,000 revenue will be eliminated on consolidation. Inventory component at 30th September 14. So this is basically closing inventory. Okay. An inventory of component at 30th September at cost to beta. This is opening inventory, which will be last year's closing, right? Now why it is nil in gamma? Because it is acquired during the year, there were no sales in the earlier year. Okay, so this is normal intercompany adjustment. Earlier problem we saw in balance sheet, now it is P&L, that's it. Now in balance sheet, in P&L problem they have inserted employee benefit related question. Post employment benefits. The group makes contributions into both defined benefit and defined contribution retirement benefit plans. All the employees of beta and gamma are members of defined contribution plans, but many of the employees of alpha are members of defined benefit plan. The following are the relevant details regarding the defined benefit plan. That means there is an adjustment for defined benefit plan only, nothing for contribution. Obligation at 30th September 14, 40 million, and 30th September 13, 32 million. So obligation means it is a liability. So this is basically my closing, and 30th September 13 is my opening. So I have a liability, opening and closing balances. Then fair value of plan assets at 30th September 14 and 30th September 2013. So I have opening and closing balances of assets. Current service cost for the year ended 30th September 14 is 6 million. That means that will increase my liability. Contributions paid into the plan by alpha in the year 30th September 14 is 5.4 million. Contributions. So when you pay the contributions into the fund, your asset increases. Benefits paid to retired members 2 million. So when you pay the benefits, your liability reduces and your asset also reduces. Relevant market yield is 5%. That is my discount rate throughout the period, right? Now, if you remember, we have solved a similar problem when we studied IAS 19 employee benefits. The actuarial gain and loss was a balancing figure. That is a similar kind of problem here. Now we have all the relevant data. Alpha has charged the contributions paid into defined benefit plan in the year ended 30th September 14, 5.4 million as administrative expenditure. expenses. Now this is a wrong entry. Contribution paid should increase my asset. What they have done? They have expensed it out. So what I have to do? Reduce expenditure and add it to asset. Alpha has made no other entries in respect of this plan in the statement of profit and loss and other comprehensive income. However, Alpha correctly accounted for the defined benefit plan in the financial statements for the year ended 30th September 2013. Last year, everything was perfect. Current year, they have not accounted anything in P&L in OCI. So P&L में क्या जाएगा? Current service cost will go, net interest cost will go, right? So current service cost we already have 6 million and net interest they have given 5%. So we'll have to compute it. So we will require a working note for it. And OCI में क्या जाता है? Remeasurements, which is nothing but actuarial gain and loss, both on assets and the liabilities component. So that becomes a balancing figure when we compute opening balance, then add net interest, add current service costs, less contributions, etc., etc., and we have closing balance. So balancing figure is nothing but your actuarial gain or loss. So once we prepare a working note, you will have more clarity. Next, following the acquisition of Gamma on 1st February 2014, the directors of Alpha formulated a plan to reorganize the group. The plan involved some redundancies and some employees changing their roles within the group. As a result of the reorganization, certain non-current assets of Alpha will no longer be required. The final version of the plan was agreed on 31st July 2014 and made public on 15th August 2014. Very important dates, 31st July 14 and 15th August 2014. The implemented from 1st November 2014. So this is not relevant when it is implemented. The total cost of the plan will be borne by Alpha. The directors of Alpha made a provision with a corresponding charge to profit or loss in respect of the plan as follows. Now if you look at IS 37, provisions, contingent liabilities and assets, this is relating to the restructuring cost. And when you should make a provision for restructuring cost, when the decision about the restructuring are communicated to the respective people who are affected by this restructuring. And they have communicated during this year. That is before 30th September 2014. That means we have to recognize the restructuring related cost. So this is the first guidance, whether you have to recognize or not. If yes, what are the amounts to be recognized? Are you getting me? So the first thing we have decided, they have to recognize because the information was made public before the year end. It has nothing to do with when it was actually implemented. So 1st November is the implementation date, which is irrelevant for us. Now, during that restructuring, they have expensed out certain costs. First is redundancy cost 10,000. Cost of training staff in new roles is 5,500. And expected profit on sale of surplus of non-current assets, they have reduced 1,500. Now, as per IS 37, redundancy costs are required to be provided for. So you will include this as a provision. Cost of training staff in new roles cannot be included because it is an ongoing cost. So IS 37 does not permit us to record this cost. So you will not record this. And expected profit on sale of surplus, anyway it is a contingent asset that you cannot recognize. So out of 14,000 rupees or dollars rather, they have whatever they have recognized as a reorganization cost, out of which 10,000 is only eligible. That means you have to reverse 4,000. Okay. Now when you reverse 4,000, you have to give only one effect because it is a P&L problem. So ideally the entry should be liability debit to P&L credit. Now there is no balance sheet, so only to P&L credit. That's it, 4,000. So in a P&L problem, you decide the journal entry, what has to be recorded, but balance sheet effect it is just in mind and P&L effect is on paper. Okay. Now, note 6, investment income. All of the investment income of Alpha, including dividends received from subsidiaries, has been correctly recognized in the individual financial statements of Alpha. That means Alpha has received a dividend from Beta and Gamma, which they have correctly recognized. If they have recognized it, that means there is a intercompany elimination which is required. because it is an intercompany transaction. Now, when they give such a note, there is some hidden adjustment here. Otherwise, they will not give such a note. Okay. Now, if you just go to P&L, in statement of changes in equity, you will come to know that dividends are paid. So, beta has paid a dividend of 10,000 and gamma has paid a dividend of 14,000. Right. Now, 10,000, our share will be 75%, which is 7,500. So, that has to be deducted as an intercompany transaction. However, from a 14,000 angle, please see when these dividends are paid. They are paid on 31st December 2013, and we have acquired a subsidiary on 1st February 2014. That means we never ever received that dividends only. That means there is no question of elimination. Are you getting me? So if you have not received only, how will you eliminate? But this is a hidden adjustment because this date is very important. 31st December 2013. So a lot of people make mistake here. They eliminate the dividend from gamma also. Right? So whenever there is a simple adjustment, you look twice. Is there any hidden adjustment anywhere? Okay? And that will come only with the practice. Sorry. So what we'll do is, we'll only say eliminate for beta. So you know that dividend declared by gamma has to be ignored because it is received pre-acquisition. I mean, it is not received by alpha at all. Note 7, bond issue. On 1st October 2013, Alpha issued 300 million $1 bonds at par. Underline 1st October 2013, which is the first day of the financial year, and 300 million $1 bonds. The interest payable on the bonds is 5% per annum, payable on 30th September in arrears. So what is the amount of interest they are actually paying? 5% per annum arrears. So on the last day of the financial year, they are paying 5%. So on 300 million, they are paying 5%. The bonds are repayable at par on 30th September 2023. So underline 30th September 2023. So after 10 years, these bondholders will get back their 300 million. And each year they will get 5% interest. Alternatively, the investors have the option to convert bonds into equity shares in Alpha on 30th September 2023. So option to convert bonds. So this becomes a convertible bond. Compound financial instrument again. On 1st October 2013, Alpha recognized a financial liability of 300 million in its statement of financial position. On 30th September 14, Alpha recognized interest paid on the date as a finance cost in its statement of profit and loss. That means whatever we do under Indian GAAP, record liability, whatever interest you pay, that is recorded as an expenditure. So first what we need to do is calculate the present value of the liability component. So 300 million you are going to pay after 10 years, but 15,000 you are going to pay every year as interest. So you need to plot your cash flows, 300,000 and 15,000, right? So 15,000 payable every year and 300,000, that is 3 lakh, payable after 10 years. Now you have to compute the present value of these payments. The difference between 300 million and present value of the payments is equity component, and then you do unwinding of discount. Now what is my interest rate? On 1st October 2013, investors would have expected an annual return of 8%, underline 8% on non-convertible bonds. That means market rate of interest on pure liability component would have been 8%. At a discount rate of 8%, the present value of $1 receivable at the end of 10 years is 46.3 cents, and $1 receivable at the end of each of 1 to 10 years is 6.71. Why these two discount rates are given? Because interest is payable annually and principal is payable only at the end. So it is very simple. You don't have to really do all the calculations, what you need to do is 0.463 into 300 million, that is the present value of the principal component, and 15,000 into 6.71 is the present value of the interest component. Okay, so present value you can calculate just in a 30 seconds time, that's it. You don't have to actually plot the cash flows and calculate, or no need to do 1 divided by 1.1 etc. They make your life little bit easier, don't worry. Now similar to our earlier problem, only thing is they have given an interest component and it is a P&L problem, that's it. Note 8, other comprehensive income. Both alpha and gamma have financial assets which are appropriately classified at fair value through other comprehensive income. On 1st February 2014, the fair value of the financial assets of gamma had not changed from 30th September 2013. Now you have to link it with this note number 2, this sentence. The profit of gamma accrued evenly, but see note 8 regarding OCI of gamma. Okay, now we are seeing that note, OCI of gamma. Now they are saying on 1st February 2014, the fair value of financial assets of gamma had not changed from 30th September 2013, which is the opening balance. Now tell me, what is the total value of OCI amount in the books of gamma? It is 1,400. This amount I am talking about. Now, I know that this is not to be done on a pro rata basis. They have clearly given. So either it is pre-acquisition or it is post-acquisition. Now what is according to you? Post or pre? See, 1,400 is the amount for the year, because OCI में for the year ही amounts आते हैं. Now it is pre or post? Correct, it is post, because they are saying, let's read it again. They are saying the fair value on 1st February has not changed from 30th September. So whatever was the fair value on the opening was same as on the date of acquisition. That means there is no change from the period of 1st October to 1st February. So whatever is changed is from 1st February to 30th September. And you have to consider entire amount in the consolidation. Are you getting me? Are you getting me? Yes or no? Yes, yeah. So let's write entire is post acquisition. Relating to gamma. Note number 9, forward currency contract. On 15th August 2014, Alpha entered into a commitment to supply a large consignment of components to a foreign customer whose currency is kroner. The agreed value of the order was 25 million kroners, and this amount is expected to be paid by the customer on 30th November 2014. So we have like pre-committed kind of sales in the next year. Kroner is generally the currency in the Scandinavian countries, Norway, Denmark, Sweden. On 15th August 2014, Alpha entered into a contract to sell 25 million kroners for $13 million on 30th November 2014. So this is basically a forward contract. They are going to sell 25 million for $13 million because the agreed value is 25 million. So in the next year, they are going to receive 25 million kroners, but their currency is dollars, and that is why they have entered into a forward contract. Currency fluctuations in August and September 14 were such that on 30th September 14, the fair value of this currency contract was 1.1 million financial liability. That means the mark-to-market loss on this forward contract is 1.1 million. Now let's see whether normal derivative accounting is applicable or hedge accounting is applicable. The draft financial statements of Alpha Do not include any amounts in respect of this currency contract since it has zero cost. Alpha wishes to use cash flow hedge accounting wherever permitted by IFRS. The directors of Alpha have estimated that the currency contract is perfectly effective hedge and perfectly effective hedge of the commitment to supply the components. It means you have to apply hedge accounting. So generally you should have debited to P&L, but now since you are using a hedge accounting, 1.1 million will be recognized in OCI and second effect in liability balance sheet, but that has to be ignored. So what is the adjustment? 1.1 million will be only included in OCI, that's it. Okay. So generally when you see forward currency contract, it is a simple adjustment. It is not a difficult adjustment. Okay. Generally the first impression of the participants is that a forward currency aa gaya hai. So it is a simple adjustment. Right. Now what you are required to prepare? Prepare the consolidated statement of profit or loss and other comprehensive income of Alpha for the year ended 30th September 14. So both P&L and OCI. You do not consider deferred tax effects of any adjustment. Completely ignore entire deferred tax in a P&L problem. Right. But they compensate with some other tough questions. Don't. So that is for 32 marks. And then you are also required to prepare consolidated statement of changes in equity of Alpha for the year ended 30th September 14, including a column for non-controlling interest. That is for 8 marks. Right? You should show all the workings to the nearest thousands. So let us start solving. So I'll take you through P&L structure first. So P&L won't have that much of changes. It will be same as compared to what is given in the problem generally. So you will have revenue, cost of sales, gross profit. Now in ACC examination, your P&L will be always prepared using function and not nature. Ind AS is done on a nature basis. Right? Function is revenue, cost of sales, GP, distribution cost, admin cost. What is nature? Revenue, other income, total income. Then you have employee benefit cost, depreciation, other expenses, then consumption, changes in inventories, etc. That is nature. Please don't consider nature for ACCA. It will be always function. So distribution cost, admin cost, redundancy cost, investment income, finance cost. All these are given in the problem itself. So don't need to add anything else. What you need to add is in OCI. Gain on financial asset is already there. Now this is an additional item. Actuarial gain or loss on defined benefit retirement plan, because that was a part of your adjustment. So this is an additional line item, and your cash flow hedge is an additional item. Now when you will prepare OCI, please note that you have to bifurcate OCI between items that will be reclassified to P&L and will not be reclassified to P&L. So when you read the problem, you should be able to grasp that these will be the two additional line items in OCI. Then you have total comprehensive income for the year, that is total. Then this is new, which every P&L problem will have. Profits attributable to parent and non-controlling interest, and total comprehensive income attributable to parent and non-controlling interest. Individual standalone financial statements would never have this kind of line items, right? So entire this page is basically an additional in Conso P&L. Then from a statement of changes in equity angle, we have to prepare a summarized version. So it will be attributable to parent and attributable to non-controlling interest. They have specifically told us to prepare this additional column. Anyways, we prepare it in practice, but in problem they have specifically asked, right? So opening balance, now increase due to acquisition is, we had written over non-controlling interest that we will consider in the preparation of statement of changes in equity. Then equity element of bond issue, because there is a convertible bond, so it will come in statement of changes in equity. Then comprehensive income for the year, that is just a balance from the P&L and OCI, and dividends paid during the year, and closing balance. So this is a structure. From a working note perspective, Generally all the line items in P&L will have a working note because there are adjustments. So revenue is there, cost of sales is there. Now we also have to calculate the impairment for goodwill in beta. So for all the 4 units separately, admin expenses, redundancy cost, there is a working note, investment income, there is an adjustment, finance cost, there is an adjustment. Then there is a finance cost on convertible loan also, equity element of bond issue, there is an adjustment on convertible loan. Then employee benefit adjustment, actuarial gain or loss calculation. Then from working note number 10, it is post P&L. So you have to calculate non-controlling interest in profit. So profit attributable to NCI and total comprehensive income attributable to NCI. Then working note number 12 is opening equity of Alpha Group. So that is relating to statement of changes in equity, and opening non-controlling interest again relating to statement of changes in equity. So 12 and 13 working notes are for statement of changes in equity. Up till working note number 11, it is relating to profits and OCI. Right. So let's start with note number 1. Note number 1 talks about, first is amounts to be included in statement of changes in equity, but statement of changes in equity we will prepare only once P&L is done. So let us start with the calculation of impairment of goodwill, that is given in note number 1. So working note 3, impairment of beta goodwill. Go to working note number 3, impairment of beta goodwill. Right. So first item will be whatever is given in the problem, carrying amount. Carrying amount excluding goodwill. Right. What are the amounts? Unit 1 is 45,000, then 55,000, then you have 30,000 and 30,000. Then allocated goodwill, given in the problem again between 4 units. What are the amounts? 8,000, 4,000, 3,000 and 3,000. Take a subtotal. So it will be 53,000, then 59,000, 33,000 and 33,000. Okay. So we have got the carrying amount after allocation of goodwill. Now we will compare this with recoverable value. So next item, recoverable amount. Again given 50,000, 65, 35 and 35. Right. So whether there is impairment in unit 1? Yes, because carrying amount is more than the recoverable value. Right. So there is an impairment of 3,000. Impairment equals in unit 1 3,000 because carrying amount is more than the recoverable. Unit 2 no dash, unit 3 dash, unit 4 dash. So only impairment is required in unit 1. Yes. Yes, that. So what we are doing then? So that carrying amounts were before allocation of goodwill. In the problem, there is no recoverable amount for goodwill separately as such. It is for the entire CGU. See, what is the recoverable value? Value in use or fair value, whichever is higher. So it is considered to be a amount as entire CGU, not for goodwill or without goodwill. Yes, of course, because we are allocating the goodwill separately. Right? Now there is an impairment of 3000. They have said charge it to cost of sales. So ideally the entry should have been cost of sales debit, that is impairment, credit goodwill. But credit goodwill not required, no balance sheet. So go to cost of sales working note. Now first write whatever is given in the problem as always. So alpha plus beta plus gamma. Now there are two subsidiaries. So you have to add all the three amounts. So alpha plus beta plus gamma. Now one more important point, gamma is only for 8 months. So 8 divided by 12. Right? Yes. So what is the amount of cost of sales given in the problem? Yes. So it is 1,30,000 plus 1,10,000 plus 90,000 into 8 by 12. 3 lakhs or 300,000. Now a very important tip, how to use a calculator. Generally we are used to calculate alpha amount first, then beta amount first, then put m plus or whatever you remember, and then calculate gamma into 8 by 12. So for every amount you will take 5 to 10 seconds extra or more than that. So what you do is first do gamma into 8 by 12, you will get the amount and then just add alpha and beta. Simple tricks to save lot of time. Got it? Now from henceforth if you have done the reverse way, please calculate gamma into 8 by 12 first and add alpha plus beta. So no need to use m plus, memory recall, etc. etc. Now second is what? Impairment of beta goodwill. Impairment of beta goodwill. Coming from working note number 3. Positive or negative? Positive, because I am increasing my cost of sales. This is my cost ka working note, right? And impairment is a cost for the company. So add 3,000. Very important, signs. Chalo. So working note number 1. Yeah, final we will take it as reduction only from the profits, obviously. Yes, so note 1 is done. Note 2, what we need to do is we have to calculate the extra depreciation on the assets which are fair valued as on the date of acquisition. So we have already written that 9 million is a depreciable component and 7.2 million is a depreciable component. So write extra depreciation next. In the same working note, because they have said depreciation will be charged to cost of sales. So extra depreciation. Now first component is property. So how will you compute? So first I have to show 20,000 minus 11,000. This is a depreciable component into, first I will divide by 25. So into 1 by 25, that will give a depreciation for 1 year, into 8 by 12, that will give depreciation for 8 months. What is the amount? Sorry? 2,400 or 240? On 9,000 for 25 years, how come it will be 2,400? Plus or minus? Plus, again it's a cost. 240. Generally second effect is to property, plant and equipment. No property, plant and equipment in P&L problem. So P&L is very easy, just start giving one effect to P&L, that's it. Then second is plant and equipment. Simple. What is the amount? 7,200. My useful life is 3 years, right? 1 divided by 3, so 3 years into 8 months. 8 by 12. What is the amount? 1,600. Again positive because it's a cost. Okay. So note 2 is done. Nothing else more in note 2. Now intragroup trading. Now there is a sale from alpha to beta and gamma. Now if it is a P&L problem, we also have to eliminate the revenue and cost of sales because it is an intercompany transaction. If it was a balance sheet, we never used to eliminate revenue and cost of sales because it's only balance sheet. We used to give the effect of inventory and profits. Now in this case, we'll have to give only effects in profits. Inventory तो है ही नहीं, खत्म फिर. Right, next. Unrealized profits on inventory. Unrealized profits. Or first we will do an intercompany elimination. Go to revenue. First alpha plus beta plus gamma, 8 months. Yes, tell me the amount as given in the problem. So it is 2,60,000 plus 2 lakh plus 8 months of 1,80,000. That is my total revenue. 5,80,000 less intercompany revenue adjustment. What is my total revenue? I mean, what is the adjustment for revenue? So it will be 17,000 because now both are subsidiary companies and everything is post acquisition. So it will be 12 plus 5. 17,000 plus or minus? Minus. I have to reduce the revenue. So less 17,000. Don't take total. We'll take at the end. Now, when I reduce the revenue, I have also to reduce cost of sales by the same amount. So less intercompany adjustment. You give a reference of working note 1. Plus or minus? Minus, because I am reducing my cost of sales. I am reducing my profit also, I am reducing my expenses also. So less 17,000. Now, I have taken entire 17,000 of cost of sales, but I have to reverse the certain amount of unrealized profit. So write next unrealized profit. Okay. First on closing inventory. Can I add alpha and beta and then take it? Yes, you can. Why to calculate separately for alpha and beta? Beta and gamma. You can take the total of beta and gamma closing inventory and directly compute the amount. So what are the amounts? 2,400 plus 2,000. This is my inventory amount into 20%. What is the amount? 880. Now add or less? I mean add to cost of sales or less to cost of sales? Add to cost of sales. Because I am reducing my profit. So add to cost of sales. Now I have computed on closing inventory, but there is also an opening inventory which I had reduced in the last year. So I'll have to take a reversal impact of the opening inventory. So next, opening inventory. So opening inventory, I think it was only for beta. So it was 1800. 1800 into 20%, which is 360. Now this will be minus because I am increasing the profit. That 360 was I am increasing the cost of sales last year, that I have reversed. That's it. Okay. And the impacts of both 880 and 360 will go to inventory. So no need to adjust anything now. So note number 3 is done. Now post employment benefits. Working note number 9. Okay. So we have read, and there are all the information given of opening, closing, liability, asset, contributions paid, current service cost, interest rate, everything is given in the problem. Now what they have done is, they are saying Alpha has charged the contributions paid into defined benefit plan as an administrative expenditure. Are you getting me? So I have to reduce the administrative expenditure to that extent. So first I will reduce that. So first write alpha plus beta plus gamma for 8 months. What is the amount? Yes. So 25,000 plus 20,000 and 8 months of 18,000, which is 57,000 given in the problem. Less. Why less? Because I am reducing my cost. It is incorrectly charged. Less contributions paid. Contribution to defined benefit plan. 5,400. Okay. This is a wrong entry earlier they had done. I am just rectifying it. Where it should have been gone? In the balance sheet, that we will take in the working note. Now, on working note number 9. Now, how do I start? I always start at the opening balance. Opening balance. What is my opening balance? Liability is 32 million. So 32,000, and asset is 27,000. So I will write asset in bracket. So there is a net liability of 5,000 on the opening. Okay. Now if you see, contributions are paid at the end of the year, and benefit payments they have not given any date. So generally the interest that you calculate is on opening, then contributions you will add it and benefits will deduct it, but assume that everything on the last day, right? So directly I will calculate the interest at the rate of, what is the interest rate? 5%. Calculate for the entire year. On 32,000 at the rate of 5%, what is the amount? 1,600. So 1,600 will increase my liability. On 27,000 interest income 1,350, so that will increase my asset. So when the asset is increasing, I am writing in bracket. What is my net interest? 250 expenditure. Okay. Now next is current service cost. So write current service cost. What is current service cost? Increase in the present value of defined benefit obligation pertaining to the current year using an actuarial method. Now current service cost will add to my liability, reduce it from liability, increase to my asset or reduce from asset. Add to liability. So what is the amount? 6,000. Nothing to do with asset, so give dash, and net is 6,000. Now what is next item? Contributions. Contributions paid. What will happen with contributions? Anything to do with liability? No. Liability dash. Whether it will increase my asset or decrease my asset? Increase my asset. So what is the amount? 5,400. So since it's an increase, I am writing in bracket 5,400. Outer column 5,400. The next item is benefits paid. Sorry. Benefits paid. It will decrease the liability. It will decrease the assets also. So what is my benefits paid? 2 million. So I will write 2,000 in bracket under liability and 2,000 as positive under asset. Okay. Net is dash. Anything remaining? Yes. Closing balance. So closing balance. Given 40,000 for liability and for asset 34,000. So balance net liability is 6,000. Now what is the balancing figure? Amounts to be recognized in remeasurement, that is it would be actuarial gain or loss and difference between actual income and the interest income, right? So remeasurements component, remeasurement component, this is a balancing figure, balancing amount. Compute. Now this is pure mathematics, there is nothing IFRS about it. Remeasurement amount. So in liability column, tell me there is if there is a loss or it is a gain. So how will you do it? You compute the total of 32 plus 1,600 plus 6,000 minus 2,000. If that amount is lesser than the closing balance, that means there is a loss, right? So is there a loss? What is a loss? 2,400 is a loss. So I will write in positive because that is increasing my liability. Okay. Similarly, do it for asset. Increase in asset. What is the amount? 2250. Is everyone getting the same answer? 2250 increase in asset. So I will write in bracket 2250. So net amount is 150 minus, expenditure. Right? Now I am preparing only P&L and OCI. So what are the relevant amounts for me? First is interest cost, that will be added to the finance cost. Then you have current service cost, which will be added to administrative cost. And then you have remeasurement, that will go to OCI. Got it? So interest, service cost and remeasurement, all these three items are P&L or OCI items. I will take it to the respective working notes. So first is current service cost 6,000. Nothing is given where to be added. So generally do it on an administrative cost. It is not wrong if you add it to cost of sales also, but if nothing is given, on the safer side, administrative cost. Go to administrative cost, working note 4. Current service cost. 6,000 positive, increasing my cost. Then I have interest cost. So I have a working note for finance cost. So first write alpha plus beta plus gamma. Gamma is 8 by 12. Tell me what is given in the problem. So 26,000 plus 15,000 plus 12,000 into 8 by 12. 49. Okay. Then next will be finance cost or interest cost. Interest cost on net defined benefit liability, coming from working note number 9. Earlier I forgot to write a working note here in administrative. Current service cost from working note number 9. Here, working note number 9. Just give a reference. What is the finance cost? 250. Positive or negative? Positive. It is my cost. So two elements given. Now third element is remeasurements. That is actuarial gain loss. That will directly go to OCI. No need to prepare a working note. So directly go to the main answer. This is what I am referring to. This is coming from working note number 9. And amount is 150, right? So it's a cost. So I will put it in bracket because generally all other positive, revenue numbers are in positive, costs are in negative. So 150 is in bracket. It's a cost. Right? You got this employee benefit adjustment. So if you know the concepts of employee benefit standard, then you will be able to easily plot this adjustment. Yes. Where it is provided. They have said they have not done any entries, right? If you read this, Alpha has charged only contributions paid into defined benefit plan in the year ended 30th September 14 as an administrative expense. Alpha has made no other entries in respect of this plan in the statement of profit and loss and OCI. So they have only whatever contributions they paid, they have recorded an expenditure of 5.4 million. Apart from that, they have not recorded even a single entry. See, generally these entries happen only when the actual evaluation report comes. It is not like a normal entry. It is only a reporting year-end entry. So they have not recorded apart from contributions paid. And why they have recorded for contributions paid? Because that is actual outflow of money. So if credit is given to bank, debit किधर तो जाना चाहिए ना फिलहाल सही या गलत किधर तो जाना चाहिए. So they have debited the expenditure which was wrong. Okay. Shall we proceed? Now note number 5. So note number 5 we have already discussed. Out of these three costs, 10,000, 5,500 and minus 1,500, only 10,000 is the correct cost that has to be recognized as a part of P&L. However, the suggested answers require us to prepare a working note and give a reason why you are including a cost and why you are excluding the cost, because that has half of mark for the reasoning. So go to the working note. Working note number 5. Okay, so don't do a shortcut. Give a reasoning also, because that will fetch you half of mark. Right, so right here, first is redundancy cost. Which is how much? 10,000. Now why you are including this? Because you have an obligation. Whether it's a legal or constructive obligation, it's a constructive obligation because you have made it in public and you have made others to believe that you are going to do restructuring. It is not legally required to do, but it is a constructive obligation. So just write here constructive obligation. So when you give reasoning, you will get complete marks for that particular adjustment. So you know why you are including it. Then second is cost of new staff training. Cost of new staff training. So you will exclude because this is an ongoing cost. So exclude because it is ongoing costs. It is nothing to do with the restructuring, it is relating to the next business that you are going to implement. So dash, you will not include that. And expected profit. Expected profit on sale of assets. So you will write exclude because it is a contingent asset which cannot be included. So dash. So earlier you had recognized 14,000, now you will recognize only 10,000. Okay. So if you write this, you will get full 1.5 mark for this adjustment. If you do not give a reasoning, I think half mark will be deducted. Next, investment income. So what happens in case of investment income? You have to reduce the intercompany adjustment for the receipt of dividend from beta. So first, go to working note number 6, investment income. First will be alpha plus beta plus gamma, 8 by 12. Yes, tell me the amount. So 12,600 plus 8 months of 1,500, 13,600 given in the problem. Now intra-group elimination of intercompany dividend. Elimination of intercompany dividends. Beta. Dividend amount is 10,000, right? Dividend is 10,000 declared by beta given in the problem. What is your share? 75%. So 7,500 minus. Now the second effect of the dividend I will show as a reduction in the statement of changes in equity directly from the non-controlling interest column, because 2,500 is received by non-controlling interest. So I will show as a reduction from that place. And for gamma, nil, give a reasoning because that will fetch you another half mark. So you will write it ignore since it is pre-acquisition, right? So whenever anything is given in the problem and you are not taking that amount, please give a reasoning why you are not taking the amount, because for every reasoning there is a half mark, right? So investment income adjustment is done. Now the bonds issue. Go to working note number 8 and 9. So we have discussed that we have to compute first the present value of the liability. The difference between the cash proceeds and the present value is the equity component. So working note number 8, write present value of liability component. Calculate. How will you compute? 300,000 or 3 lakhs that is payable at the end of 10th year. So it has a discount rate of 0.463 plus 15,000 is payable every year. So the discount rate for 1 to 10 years is given as 6.71. So what is the liability element? 239,550. Okay, so that is the present value of the liability component. 300,000 is payable at the end of 10th year, so 0.463 is the discount rate for that, and 15,000 is payable every year in arrears. So if you just add the discounting rate for the respective years from 1 to 10, you will end up having 6.71. Right? So 239,550 is the liability component. So let's compute the equity component. First, proceeds from bond issue 3 lakh less present value of liability component coming from working note number 8. 239,550. So my equity component is 60,450. So I will include this amount in statement of changes in equity because it is adding to my equity directly. So right here, add to statement of changes in equity. Okay, so that will be done after preparation of P&L and OCI. Now that 300,000 we have broken into two parts. Liability is 239,550 and equity is 60,450. Now on this 2,39,550 I have to provide a interest at the fair market rate, which is 8%. So write next, add interest at the rate of 8%. I think the loan is received on the first day of the financial year. So entire 8%. So what is the value? 8% of 239,550, which is 19,164. So 19,164 should have been the correct interest charge. Agree? What have they already included in P&L? They have recorded on a cash basis kind of, or at the rate of 5%. Right? So if you read the problem, they are saying that second para of note number 7. On 1st October 2013, Alpha recognized a financial liability of 300 million in its statement of financial position. On 30th September 14, Alpha recognized interest paid on that date as finance cost. That means they have recognized 15,000 as a finance cost. They should have recognized 19,164. So differential we have to additionally recognize. So right, interest already charged, 15,000, additional interest on convertible bonds. It will be 4,164. Okay, where I will include this 4,164? Finance cost. add additional interest on convertible bonds. Working note number 8. 4164 plus or minus? Plus, I am adding to the cost. 4164. Right? Yes. Now, next, last adjustment. Or other two adjustments, but note it is actually there is no adjustment to be computed. So, other comprehensive income we have already discussed that entire change relating to OCI is a post acquisition, right? So, whenever we will close P&L and OCI, we will directly take that entire 1400. So, nothing to do about it right now. And forward currency contract, we have also discussed that 1.1 million is a financial liability. So, I will include that amount in OCI since hedge accounting is followed. Now, there is no working note which is required. Directly go to OCI and give the impact of 1100. Main answer OCI. You see cash flow hedges, right? Items that may be reclassified to P&L. 1100 is a loss. So, I will write in negative. Second impact is to liability balance sheet. So, no need to give second impact. Done. Now, P&L all the adjustments are done. Now, let us close each working note and start posting it to P&L. Total of revenue. Yes, 5,63,000. 5,63,000 posted to revenue. Cost of sales. $2,88,000. 2,88,360 posted to P&L. Now, since this is a cost, you show it in bracket 288,360. Right? Gross profit and all will compute later on. Let's first close the working notes. So, working note 3 is closed. Administrative expenses is 57,600. Total of administrative expenses is 57,600. Since this is a cost, I will write in bracket 57,600. Working note number 4. So, here also write working note. Revenue was 1, cost of sales was 2. Next. Redundancy and reorganization is 10,000. Take the total of investment income, finance cost, and then we will post it together. What is investment income? 6,100. And finance cost? 53,414. Okay. Let's post all these three amounts to P&L. So, redundancy and reorganization is working note number 5. 10,000 is my cost. Investment income is working note 6 and amount was 6,100. Income है इसलिए positive 6,100 and my finance cost coming from working note number 7 which is 53,414. 53,414 bracket, since it's a cost. Now any other working note pending? 8 is closed, 9 is closed. Then we have to close the P&L first. Take the gross profit. Total of gross profit. Till take it, don't worry. 2 lakh 274,640. Distribution cost is just an addition. So what is the amount? 20,000. No adjustment, just an addition. Plus 15,000 plus 13,500 into 8 by 12. 44 cost. 44,000. It's a cost. Compute profit before tax. 115,726. Income tax, no adjustment, just take total. So it is 14,000 plus 10,000 plus 8 months of gamma, 12,000 into 8 by 12. What is my income tax expenditure? What is, sorry? 32,000. My profit after tax? 83,726. Okay. Now, gain on financial assets at fair value through other comprehensive income. So what I have to do is include both the amounts. Alpha तो करना ही है. Beta, I don't think so there are any amounts. See, alpha has 9,000 if you look at the problem, beta is nil and gamma is 1,400. So 1,400 is entire post acquisition. So include both 9,000 plus 1,400. 1,400. So that is 10,400. Positive, it's a gain. Then we have already written 150 negative as actuarial loss and cash flow hedges loss again 1,100. Now what is my total comprehensive income, which is addition of profits and all these three amounts? Yes, 83,726 plus 10,400 minus 150 minus 1,100. 92,876. Okay. Now I have to divide 83,726 between parent and non-controlling interest and divide 92,876 between parent and non-controlling interest, and for that we would require a working note, right? So first is I have to divide 83,726, profit attributable to owners and non-controlling interest, right? So go to working note number 9. 9 or 10? 10. 10, sorry. Now, what should be the starting point? Whatever is the profit given for the respective subsidiaries is my starting point. See, I have also seen people directly computing 20% of the total profits. Please don't do that, right? So sometimes it may happen in the exam. NCI का share, it is only attributable to the subsidiaries profit, not the total profit, right? Now, right now, profit. Yes, what is the profit given in the problem? 30,000. So beta का है 30,000 and gamma is 36,000. But that 36,000 is again for the entire year. So 8 by 12. So 30,000, and that is why I have written 8 by 12. So it will be 36,000 into 8 by 12, which is 24,000. Right? So this is nothing but, I will write somewhere here, 36,000 into 8 by 12. Right? Now, have we passed any adjustments relating to the books of the subsidiary company? So you look at all the adjustments that we have done and check whether it is anything relating to beta or gamma. So the first adjustment itself is relating to beta, which is impairment of goodwill. So if you are impairing the goodwill, you should also allocate some portion to your non-controlling interest. So next item, impairment of beta goodwill. Impairment of beta goodwill, coming from working note number 3. So that will be 3,000 reduced from the profit. There is no impairment in goodwill of gamma. Now, whether my inventories is a downstream transaction or upstream transaction? Downstream. So no need to include any profits here. If it would have been upstream transaction, I would have included that profits in this working note, because some portion I will allocate to non-controlling interest, right? But everything is downstream in this transaction. Now check each and every note. Have we done any adjustment relating to subsidiary companies? See, first goodwill we have done. So coming to note number 2, now there is alpha's investment in gamma. So we have charged extra depreciation on the assets of gamma. So if extra depreciation is charged, we should also give some share to non-controlling interest. So write next, depreciation. Extra depreciation. Working note number 2, extra depreciation. Working note number 2. What is the amount? Check. $240 and $1,600. $240 and 1,600. Anything relating to beta? No, it is relating to gamma. So it will be 1840 minus. Let's look at some other adjustments. Note 3, intra-group trading, we just now discussed, it is entirely downstream, so no need to add it to any beta or gamma. Then post-employment benefits, all the adjustments are in alpha, so nothing to do with beta. Redundancy and reorganization cost, again everything is in alpha. Then investment income, again we have reduced it from alpha. Bond issue is also in alpha. Then OCI, nothing to do with this item as well. Forward currency contract is also in alpha. So that's it. Compute the profit. Take the subtotal. 27,000 and 22,160. Now, what is the share of non-controlling interest? Non-controlling interests in beta, it is 25%, na? Because 75% is owned by alpha. So 25%, and in gamma it is 20%. So what is the amount in beta and gamma? So 6750 and gamma is 4432. So my total non-controlling interest is 6750 plus 4432. 11,182. Got it? So we started with the respective profits of the subsidiary companies. We considered 8 by 12 because it was a pro rata acquired during the year, and we made certain adjustments relating to the subsidiary companies, which should also be given an effects in non-controlling interest. That was impairment of goodwill and extra depreciation on assets of gamma. And then we applied respective NCIs on the revised profits and calculated total non-controlling interest. Now this 11,182 will be shown where profits attributable to non-controlling interest. Here, profits attributable to non-controlling interest coming from working note number 10. 11,182. What is my total profit? 83,726. So net profit for the year was 83,726. That means balance is attributable to owners. So what is the amount? 72,544. So that is a balancing amount. Okay. Now similarly, we also have to compute the total comprehensive income attributable to owners and non-controlling interest. So the total is 92,876. 92,876 is the total. Now first again we will compute for non-controlling interest and then balancing figure will be owners. Now working note number 11. See, now your total comprehensive income is the sum of net profit and other comprehensive income. Now we have already done work till net profit. So we have a starting point of 11,182 already. Are you getting me? Don't compute everything all along again. We already have 11,182 as the starting point and we just need to include amounts relating to OCI. Are you getting me? Total comprehensive income is an addition of P&L and OCI, out of which P&L we have already computed from working note number 10. So just write directly non-controlling interest in profits. Non-controlling interests in profit coming from working note 10. 11,182. Now we have to look at what are the items in OCI and out of which items relate to the subsidiary company. Are you getting me? Owners का तो NCI है नहीं. So let's have a look at OCI items. Right. Now there are only three items. One is gain on financial asset, second is actuarial loss, and third is cash flow hedges. Now in 10,400 there are two amounts, 9,000 which is relating to alpha and 1,400 which is relating to gamma. That means 1,400 is a component relating to NCI. 1,400 में से NCI को उनका share देना है हमको. So just keep in mind. 150 anything to do with beta or gamma? No, entirely pertains to alpha. So ignore 150. Cash flow hedge 1,100 again entirely pertains to alpha, nothing to do with beta or gamma. So out of all these four items, there is only one amount which is relating to gamma, 1,400. So you give 1,400 into their share and that is it. So go back to the working note. Right? So non-controlling interest in other comprehensive income. Will be 1,400 into gamma का कितना share है? 20% ना? So 1,400 into 20% gamma का share. So it is 280. So now total non-controlling interest in total comprehensive income will be 11,462. 11,462. Take it. So this is coming from working note number 11. 11,462. So owners of alpha, balancing figure, balancing amount. What is the amount? 81,414. Okay. We have just completed 32 marks. P&L and OCI is done. Now, statement of changes in equity for next 15 minutes for 8 marks. Any questions in P&L and OCI? Okay. Now, let's go to statement of changes in equity. So, first I have to compute the opening balance of equity pertaining to alpha and pertaining it to non-controlling interest. Okay. Now, we have a working note prepared for that. How will I start? Any idea? See, I have individual net assets of alpha, beta and gamma. But now I have to compute the consolidated net assets as on the opening balance sheet date. So how would I start? So logically what should all be included? So alpha का तो खुद का आ ही जाएगा because it is a parent company. Then from a gamma's perspective, from a beta's perspective, what should be added? No. So that is the entire, na? See, okay. Now this is the statement of changes in equity given in the problem. 1,80,000, 1,40,000, 1,20,000. Now what I have to do is I have to compute the consolidated equity. Are you getting me? Now tell me one thing, whether I should include 1,80,000? Yes, because it is alpha's own equity. Whether I should include 1,20,000 relating to gamma? No, because it was acquired during the year. So 120 ignore. Should I include entire 140? No, I will only include post acquisition profits. Are you getting me? You will only include post acquisition profits. 1,40,000 is for the entire company right from day one. But in my net assets, I will only include those amounts which are attributable to the parent. For pre-acquisition profits, you have already paid the price and goodwill is generated. Okay. So how will I compute the post-acquisition profits or post-acquisition net assets? They have given here that when they acquired beta, the fair value was 80 million. And now the total net assets are 1,40,000. So when you acquired, the net assets were 80,000. Now it is 1,40,000. That means there is a post-acquisition increase in net assets of 1,40,000 minus 80,000, 60,000. Out of it, 75% is attributable to alpha and balance 25% is attributable to non-controlling interest. Are you getting me? So let's compute the opening balance. Go to working note number. Last two working notes pending. 12. Right, first given in the problem alpha 1,80,000. See, consolidated is parent plus subsidiaries, out of which one subsidiary is not there only on the opening date. Now relating to beta, you will only include post acquisition net assets. So it is 1,40,000 minus 80,000, which is the fair value as on the date of acquisition, into 75, right? 75%. What is the amount relating to beta? 45,000. Any other amounts to be included in the opening balance? No? Shall we take total? Now, one more important point. There was last year closing inventory unrealized profit on closing inventory. Last year's closing is this year's opening. So when I prepared last year's financial statements, I would have reduced that profit. When the total profit was reduced, then I would have also reduced my share. No? Okay. Go to working note number 2. Do we have unrealized profits on inventories? So in this year, we eliminated the unrealized profit on the closing inventory of 880 and we reversed the last year's impact of 360. That means last year we had eliminated the profit of 360. So वो opening में effect आना चाहिए, because that effect has not come in the individual financial statements. It is a consolidated financial statements entry. Are you getting me? So that 360 which I am reversing in this current year, that was a last year's closing inventory which I reduced the profit last year. So when I reduced the profit last year, my net assets for the opening also reduced. Right? So this requires practice and super intelligence. So go back to the working note. Opening provision for unrealized profit. Working note number 2. 360. Add or less? Add or less? अरे less ना. Last year मैंने profit कम किया ना. This year I reversed it, but last year I reversed the profit, na? So last year's closing balance, net asset should have been reduced or increased. It should have been reduced, right? So 360 is less. नहीं समझे? See, okay, again go to working note number 2. Now, don't refer to this 360, refer to 880. Why we increase to the cost of sales? To reduce profit. That means last year 360 जो अमाउंट था, तो लास्ट ईयर का भी रिड्यूस करना चाहिए था प्रॉफिट. तो रिड्यूस करना चाहिए था मतलब नेट एसेट्स कम होगा ना मेरा. So that is why less. See, 880 is to current year, 360 is to last year. Are you getting me? So 360 हमने लास्ट ईयर का रिवर्स किया. That means it was a cost last year. So cost है मतलब मेरा नेट एसेट्स कम हुआ. So less 360. I told you P&L problem, right? 360. Now, should I take only my share of 75% here? Whether it was a downstream transaction or upstream transaction? Downstream. So, is it required to take only 75%? No, because entire profit was booked from a parent's perspective. Now, if it was an upstream transaction, then I would have taken only my share. And in opening non-controlling interest, I would have given their share. So tomorrow if the problem comes for upstream, you should be able to tweak that and do the adjustment. Got it? Yes. Now there are no other adjustments, take the total. You are not in the process of processing other adjustments now. Right, take the total. Right, what is the amount? 224,640. Now add here, post it to statement of changes in equity. Opening balance from working note number 11, right? Or 12? 12. And this second amount is going to come from 13. So amount was 2,24,640. Similarly, I have to compute for non-controlling interest. Now it is easy, non-controlling interest. See, now non-controlling interest again comprises NCI value as on the date of acquisition plus post increase in profits. So at the date of acquisition we have already written here. You see this amount, alpha arose on the acquisition of beta, on 1st October alpha measured its non-controlling interest at fair value at 22 million. And we have written here to be considered for preparing statement of changes in equity, both these amounts 80 million and 22 million. So now opening balance of NCI is 22 million and then we will give the respective share till the opening date. At date of acquisition. So it was 22,000. And post acquisition increased. So again 1,40,000 was opening minus 80,000 was as on the date of acquisition. Now only 25% NCI share, which is 15,000. So total is 37,000. Right, 22 was at the date of acquisition given in the problem, and post acquisition increase 15,000. Take this 37,000. What is the total of opening balance? 261,640. Now we have completed the last year's acquisition. Now because of the current year's acquisition there was increase in non-controlling interest, right? So what was the fair value of non-controlling interest relating to gamma for this current year? So this is given in the problem again. So again we must have written, dekho here, alpha measured non-controlling interest in gamma on 1st February 2014 at its fair value at 28 million, right? So this is similar to 22 million of beta. Since 22 million was before the date of acquisition, we considered in the calculation of opening amount. Now this 28 million is during the year, so that is why in the statement of changes in equity, this is not the solution. Here I have written increase due to acquisition, so that will be 28,000. Nothing to alpha. 28,000. Right? Then equity element of bond issue. Nothing to non-controlling interest because it is in alpha. So it will come from working note number. Equity element is working note number 8. 60,450, right? 60,450. So outer column is also 60,450. Then comprehensive income for the year, you just have to take the totals 81,414 and 11,462. This is just a flow from P&L OCI to statement of changes in equity. So 81,414 attributable to owners and 11,462 attributable to non-controlling interest, and the total is 92,876. And last, dividend paid. Now from alpha it will be the entire amount of dividend, right? So what is the alpha's amount? 30,000. Now beta has paid a dividend of 10,000, out of it 7,500 we have deducted as an intercompany adjustment. Now balance 2500, which is relating to non-controlling interest, we will deduct in statement of changes in equity, because we cannot deduct it from P&L. And anything relating to gamma? No, because it is pre-acquisition. So 30,000 is also less. You have paid the dividend, so it will reduce my net assets. So outer column is 32,500. Now take the vertical totals and the problem ends there. So what is alpha amount? 336,504. Non-controlling interest 73,962, and total equity 410,466, and then you get remaining 8 marks after writing this 410,466. Right? It's not difficult, it's only the first time. I already warned you yesterday that you will not feel good about the consolidation problems when you solve first 2 problems, but as and when we solve more problems, then definitely you will feel comfortable, because when you solve the 10 problems, you will find that around 90 to 95% adjustments are same. More than that, in fact, hardly one adjustment is new in every problem, and that too, that is not very difficult. Right? Any questions? So let's take a break.